Welcome back to the Finance Shark. There is so much to consider when making investment decisions, especially when you're working toward meeting specific short and long-term financial goals. Tax-efficient investing involves choosing the right investments and the right accounts to hold those investments. In this video, we are going to tell you about top tax-efficient investment accounts. The video is going to be amazing, so make sure you stick to the end. Before starting the video, be sure to smash the like button and subscribe to never miss out on any of our videos. One of the core principles of investing, whether it's to save for retirement or to generate cash, is to minimize taxes. Tax-advantaged accounts like IRAs and 401ks have annual contribution limits. For 2020 and 2021, you can contribute a total of $6,000 to your IRAs, or $7,000 if you're age 50 or older, because of a $1,000 catch-up contribution. With 401ks, you can contribute up to $19,500 or $26,000 if you're age 50 or older in both 2020 and 2021. The combined employee-employer contribution can't exceed $57,000, $63,500 with the catch-up contribution for 2020, and $58,000, $64,500 with the catch-up contribution for 2021. Because of the tax benefits, it would be ideal if you could hold all your investments in tax-advantaged accounts like IRAs and 401ks. But due to the annual contribution limits and the lack of flexibility, non-qualified withdrawals trigger taxes and penalties. That's not practical for every investor. A good way to maximize tax efficiency is to put your investments in the right account. In general, investments that lose less of their returns to taxes are better suited for taxable accounts. Conversely, investments that tend to lose more of their returns to taxes are good candidates for tax-advantaged accounts. 401k. A 401k plan is a retirement savings plan offered by many American employers that has tax advantages to the saver. It is named after a section of the U.S. Internal Revenue Code. The employee who signs up for a 401k agrees to have a percentage of each paycheck paid directly into an investment account. The employer may match part or all of that contribution. The employee gets to choose among a number of investment options, usually mutual funds. A 401k is a defined contribution plan. The employee and employer can make contributions to the account up to the dollar limit set by the Internal Revenue Service, IRS. A defined contribution plan is an alternative to the traditional pension, which is known in IRS lingo as a defined benefit plan. That is, an employer who offers a pension is committed to providing a specific amount of money to the employee for life during retirement. In recent decades, 401k plans have become more common, and traditional pensions have become rare, as employers shifted the responsibility and risk of saving for retirement to their employees. Employees also are responsible for choosing the specific investments within their 401k accounts from a selection their employer offers. Those offerings typically include an assortment of stock and bond mutual funds, as well as target date funds that are designed to reduce the risk of investment losses as the employee approaches retirement. Roth IRA. A Roth IRA is an individual retirement account, IRA, that allows qualified withdrawals on a tax-free basis provided certain conditions are satisfied. Established in 1997, it was named after William Roth, a former Delaware senator. Roth IRAs are similar to traditional IRAs, with the biggest distinction between the two is how they're taxed. Roth IRAs are funded with after-tax dollars. The contributions are not tax-deductible. But once you start withdrawing funds, the money is tax-free. Conversely, traditional IRA deposits are generally made with pre-tax dollars. You usually get a tax deduction on your contribution and pay income tax when you withdraw the money from the account during retirement. Similar to other qualified retirement plan accounts, the money invested within the Roth IRA grows tax-free. However, a Roth is less restrictive than other accounts in several ways. Contributions can continue to be made at any age, as long as the account holder has earned income. The account holder can maintain the Roth IRA indefinitely. There are no required minimum distributions, RMDs, during their lifetime, as there is with 401ks and traditional IRAs. Roth 401k. The Roth 401k account made its debut in the retirement investment community in 2006. Created by a provision of the Economic Growth and Tax Relief Reconciliation Act of 2001 and modeled after the Roth IRA, the Roth 401k is an employer-sponsored investment savings account that allows employees to save for retirement with after-tax money. Participants in 401(b) plans are also eligible to participate in a Roth account. Although the ability to contribute to a Roth 401k was originally set to expire at the end of 2010, the Pension Protection Act of 2006 made the Roth 401k permanent. The benefits associated with the Roth 401k depend largely on your point of view. From the government's perspective, the Roth 401k generates current revenue in the form of tax dollars. That's different from a traditional 401k, for which investors receive a tax deduction on their contributions. Thanks to this deduction, funds which ordinarily would be lost to the IRS remain in the account tax deferred until they're withdrawn. This was all for today. Hope you liked the video. Do not forget to subscribe to our YouTube channel. Stay safe, and we will be back soon with another video.